mind, looking for a dime. James Locke in the house, gonna help you shine.
Welcome everyone. Welcome to the Poole Locke YouTube channel. I'm James Locke. Today we're going to answer 2 more Ask James questions of the day. So we have this question from Cameron. He says, trying to get more return in the stock market, what do you think is better? Mutual funds, ETFs, or buying individual stocks? All right, Cameron, great question, and it really depends. You see, if you're talking all stocks, right? A stock mutual fund, a stock ETF, is a diversified portfolio of stocks. You can have a diversified portfolio of individual stocks and be similar to an ETF or mutual fund. So I guess the biggest difference is if you're a small investor and you're starting out, or maybe you're stuck in a 401k, you might only be able to use mutual funds, or maybe, if you're lucky, ETFs, exchange traded funds. You may not be able to do individual stocks or may not have enough to cost effectively diversify. Typically, if you have less than $250,000, you probably want ETFs or mutual funds. If you have more than that, you can go to individual stocks. But you see, Cameron, either you need to know what you're doing in selecting the stocks, or you have to work with a professional who does. You still want to be diversified, and there's different levels of diversification, but it's generally accepted in the financial world that if you own 30 stocks from different sectors, you're fairly diversified. Think about it. The Dow Jones Industrial Average is 30 stocks. The S&P 500 is 500 stocks, but yet they typically kind of track each other more or less. So as you get past 30 holdings, if they're diversified among different sectors, you don't get a lot of extra diversification benefits. So if you know what you're doing, or you have a professional advisor that knows what he or she is doing, well, where they can be a good stock picker and keep you with 30 different stocks, then guess what? You might be able to get a little more return that way if they're really good. But again, you have to have the expertise and have to at least, I would say, $250,000 to cost effectively diversify. So those are ways, Cameron, that you can take a little bit more risk to try and get a little bit more return, or try to get what the investment professionals call alpha, right? Extra return due to better stock selection if you're managing individual portfolios. Now, since you're asking about getting more return from the stock market, I want to pivot our conversation to focus on investing for income, especially as you approach retirement. This is crucial because your investment strategy often needs to shift as you near retirement age. When it comes to investing for income in the stock market, dividend-paying stocks can be a great option. These are companies that regularly distribute a portion of their earnings to shareholders. They can provide a steady stream of income, which can be particularly attractive for retirees or those nearing retirement. If you're looking at mutual funds or ETFs for income, you might want to consider dividend-focused funds. Right? Those funds specifically invest in dividend-paying stocks, aiming to provide regular income to investors. Some even focus on companies that have a history of consistently increasing their dividends over time, which can help your income keep pace with inflation. For individual stocks, if you have the capital and expertise or professional help, you could create a portfolio of dividend aristocrats. Right? These are companies that have increased their dividend for the last 25 consecutive years. They tend to be stable, well-established companies that can provide reliable income. However, it's important to remember that even dividend-paying stocks can be volatile. The stock price can go down, potentially offsetting the income you receive from dividends. That's why it's crucial to maintain a diversified portfolio, perhaps combining dividend stocks with other income-producing investments like bonds or real estate investment trusts. Also, don't forget about the potential tax implications. Dividends can be taxed differently depending on whether they're qualified or non-qualified, which can affect your overall return. Lastly, while seeking higher returns is, understandable, especially as you approach retirement, it's equally important to consider your risk tolerance and overall financial goals. Sometimes a balanced approach that prioritizes steady income and capital preservation over maximum returns can be more appropriate for those nearing or in retirement. Remember, Cameron, investing for income doesn't necessarily mean sacrificing growth, potential at least, potential entirely, right? It's about finding the right balance that allows you to meet your income needs while still giving your portfolio the opportunity to grow and keep pace with inflation over time. Great question. If you would like to send in your question, you can do so by emailing it to poollocke@poollocke.com. Moving on to our second question. This email is from Andrew, and he says, I want to maximize my return for my legacy for my children. I do not need this money for income for my retirement, so what do you suggest I do? Again, I want you to be diversified, but you could be 100% in the stock market if you want to do it, right? Exchange traded funds, and you could be in ETFs and diversify that way. You can have a little bit more in small cap funds and maybe a typical person your age because of a longer time horizon, a little bit more in growth, a little less in value. So you could take risks, extra risks, all the smart ways that we discussed. But Andrew, it's also more than that. It's about saving unnecessary fees, right? Because it's not just what you make, it's what you keep. So for example, you look in 401ks, some of the unnecessary fees are embedded in mutual funds. Some of the more aggressive funds can be well over 1%. If you can roll that money over to an IRA, you might be able to save some of those fees, right? And again, a penny saved is like a penny earned, right? You can also save on taxes. So one of the things that you might want to look at is, do Roth conversions make sense? If you're not 73 or you're not the age of required minimum distributions, maybe you can take some money out of the, at a reasonable tax bracket, pay tax on it, do that Roth conversion. So then it goes tax-free to your heirs. That might be an answer versus getting all 401k or traditional IRA assets, and then your heirs have to pay all the tax on it, probably in the maximum tax bracket. So tax planning and saving fees are important in addition to having a growth-oriented mindset. And Andrew, I hope you could, hope you kind of listen to other things we've talked about tax strategies here before, because there are different ways to help. Now, since you're focused on maximizing your return for your legacy and don't need this money for income and retirement, let's delve into that a bit deeper, some of the different strategies that can help you achieve this goal while still keeping an eye on investing for income. First, consider a strategy that combines growth and income producing investments. While you don't need the income now, reinvesting dividends and interest can significantly boost your portfolio's growth over time. This approach, known as compound growth, can substantially increase the legacy you leave behind. Look into dividend growth stocks or funds. These are companies that not only pay dividends but have a history of increasing them regularly over time. Over time, this can then lead to a growing income stream that, when reinvested, can accelerate your portfolio's growth. You also might want to explore real estate trusts, right? REITs. These can offer both growth potential and income. The income can be reinvested for growth now and later. Your heirs could potentially benefit from a steady income stream if they need it. Consider a barbell strategy where you invest in both very conservative and more aggressive investments. This could mean holding some treasury bonds or high quality corporate bonds for the stability, paired with growth-oriented stocks or even some alternative investments for higher potential returns. Don't overlook the power of gifting strategies. You could potentially start gifting some assets to your children now, allowing them to benefit from growth over a longer period. Now, this could also have tax advantages depending on your situation. Lastly, make sure you have a solid estate plan in place, right? This includes not just a will, but potentially trusts that can help manage and distribute your assets effectively or efficiently, really, into your heirs. But different types of trusts can also provide tax benefits or potential assets from creditors. Remember, Andrew, while focusing on growth is important for legacy planning, it's crucial to balance this with your own financial security. Make sure you have a robust financial plan that ensures your own needs are met first before maximizing what you leave behind. As always, consult with a financial advisor and tax professional to tailor these strategies to your specific situation and goals. Andrew, thanks so much for that great question. As always, if you would like to send in your question like Andrew did, you can do so by emailing it to poolelock@poolelock.com. If you like what you heard, go ahead, like and subscribe to our channel. I am James Locke, your retirement income source. See you guys soon.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear. Savings in the bank.